Friends, welcome to this edition of live virtual classes conducted by Board of Studies ICAI for the paper 2 final level advanced financial management. I CA Ashish Gupta, Joint Director Board of Studies and as well as faculty at BUS ICAI. Welcome to you all in this session. Now today in this session, I hope you must have gone through the lectures, recorded lectures that have been available at our portal. Now, after you going through the lectures, we are conducting live classes for resolving your doubt. So in this series, today the live session is for the topic security analysis, and our one of the very best faculty, CS Vivek Banerjee, who is also the faculty at BUS, shall mentor this session. Student, you are free to ask your queries in this session through the chat, as well as after once the class is over, we shall open the floor for the student so that you can even ask your query on the Zoom link directly. So student, now without taking much of your time, I hand over the podium to our faculty, CS Vivek. Vivek sir, good morning and welcome you all. Welcomes you all in this session of this lecture. Now it's your show, sir. Thank you.
Okay, thank you so much, sir, Ashish sir, for your kind words. Good morning, everybody. Myself, Vivek Banerjee, and I will be taking today's session on security analysis. I will be covering both this technical and fundamental analysis, and I will take the query session also. But this you take it as a revision and a recapitulation session, because as I go through the concept again, you will likely to be revised, and whatever you might have missed while attending the recorded lectures, it will come to your mind automatically. And if any doubt or any query arises, you can anytime ask in between. I would encourage you to ask alongside, because I want it to be a interactive session. So let us begin this session on this security analysis. First of all, I will likely to just complete this fundamental analysis. Pages. Okay. So students, what is this fundamental analysis? As you must have gone through this analysis of the fundamentals. So what are the fundamentals? Fundamentals we can divide it into three parts: economic, industry, and company. And this is altogether also known as, in short, EIC analysis. That is economic, industry, and the company. Economic analysis, what do you mean by this economic analysis? Economic analysis, I will go through this quickly, and in between I will give examples also so that you can correlate with this topic. Let us take the GDP. What is the GDP? GDP is the value of all goods and services produced in an economy during a particular period of time. So if the GDP growth rate, for example, in the quarterly 4, the GDP growth rate is 8.4%. And let us take it is projected by various, you can say, agencies and RBI to 9%. Let us take a hypothetical example. It is taken expected to be 9%. So what will be the repercussion on this? GDP growth rate is 8.4%. It is already good enough. It means that you can say on a general, the production and the services are you can say got a fillip, and they are taking place in a you can say in a good manner. And if it is projected to be increased by 9%, then you can very well, as a fundamental analyst, very well judge that yes, the goods and services, the industrial production will generally be on the higher side. So what will be this repercussion? Repercussion is that if the GDP growth rate higher means one can assume that the employment rate will be on a general higher, and people will have more money comparatively earlier, and there will be industrial production, more industrial production. I'm just not taking example of services. I'm just restricting my examples to manufacturing only, goods only. So there will be more industrial production. So more industrial production for this, you can say the company will require, you can say, have to establish more factories, or you can say offices. So that will lead to more jobs, because if a particular company establishes more factory, so it will need more people to actually do this industrial production, to do the manufacturing jobs. So more jobs will increase the standard of living of people, because people now will have more money into their hands, and they will likely to you can say uh, buy more things, or increase their expenses. So so consumption will also increase, because now the people will have more jobs, more money into their hands, so consumption will increase. So this increased consumption will, because they will buy goods and services also. So this increased consumption will increase the profitability of the company. So if the company's profit increases again, they will also likely to increase their production. So increase their production, this will create more jobs again, and standard of living will increase further. So this is a chain reaction. It will continue till the GDP growth rate is on a higher side. So more companies will be likely to benefit from this. And as a fundamental analyst, he can be sure that yes, most of the industries are likely to do well because of this higher GDP growth rate. There are other aspects of the economic analysis also, but GDP growth rate is the prime, because anyone, if wants to know how the economic situation is, he wants to go through the economic analysis first. Now, this is economic analysis. Now, he want to restrict it. He want to also analyze the various industries also. So the second aspect which comes to mind is industry analysis. That is, yes, the economy is doing well, but which industries are likely to do well, or which industries are doing well and likely to do well in the future also. So this will lead to industry analysis. Now, which industries are likely to do well, in which their industrial production, or you can say general production, is good. So I will just refer the PPT for a brief period of time so that you can correlate with the concept also. Yes, so this just see this slide, that when economy grows, it is very unlikely that all the industries of the economy will grow at the same time. So it is necessary to examine industry-wide factors in addition to the economic-wide factors. I will give you one example. So I will give you one example in which you can be able to just correlate this. What are the industries which are likely to get a boost? The first which comes to mind is the industries which are getting boost under the PLI scheme, that is production linked incentive schemes by the government of India. Under this, the government is giving subsidies to those industries which are in the domestic manufacturing. For example, manufacturing chips, mobile phones, electronic items, and various other things. And the government is also giving a boost to the infrastructure sector. So what are the sectors which are likely to do well if the infrastructure is giving boost? The first thing which comes to mind is the steel sector. And the second which comes to mind is the, you can say, aluminium also, wood also, because in the houses and the various construction woods are also used. And you can say cement also. Cement is a very important factor. And also the various real estate companies. Now, the one wants to restrict it with the company analysis. So first of all, the fundamental analyst makes an economy analysis. Yes, the GDP growth rate is good. It is likely to go up. And some of the industries are likely to do well. And which of the industries are likely to do well? Which are getting boost under the government's production linked incentive schemes. And second, which are giving boost because of the government's infrastructure push, that is the cement, steel, wood, and real estate companies. Now, which of the particular companies the fundamental analysis should, you can say, focus on? So the third stage is the company analysis, because yes, the steel sector is likely to do well, but which companies are likely to do well among the steel sector? It is not that all the steel companies will be likely to do well. Which among those steel companies, which among the companies are likely to do well? So then the fundamental analysis narrowed it down to company analysis. And in company analysis, he first of all see the two main aspects which he concentrate on is the, he will revise it for in financial analysis and the management analysis. So if he sees that in a particular company, say Tata Steel. Tata Steel's profitability for the last 5 years, 10 years, or sales figure is good, and it's do not have much debt. So yes, the fundamental analysis can focus on, yes, this company is likely to do well. So this way, the fundamental analysis gives his analysis. But do the fundamental analysts take decision on this on the basis of this uh, economy, industry, and company? The answer is no, because he will, the next stage is actually the valuation, which we'll see in our next lecture, the valuation aspect. So first of all, the fundamental analysis analyzes the economy, industry, and the company, and then he takes a decision whether to buy the shares of a particular company or not. On this, the aspect of valuation comes. So let us first concentrate on this fundamental analysis first. Now, before beginning this fundamental analysis, these two factors are very important, as you must have gone through the general observation and the moat of the company. General observation, what you have heard through the various news channels, what you have observed by reading the newspapers, financial newspapers, or you can say by your own seeing the company's financial statements, going through the company's annual report. So on there's this going the summary of the company's annual report. So whatever observation you have, you make a mind that yes, on an average, the economy is likely to do well. These industrial sectors are likely to do well. These companies are likely to do well. And then the second aspect which comes to my mind, very important before beginning this EIC analysis, is moat. Moat is the term which is coined by Warren Buffett, and it means the competitive advantage which a particular company has in relation to another company. And the first is the example is given that brand Royal Enfield bikes. Any other example which comes to your mind, which having a competitive advantage in relation to any other company? Another example we can give is the Colgate, because earlier now there are various companies in this field, but earlier when one wants to brush his teeth, he say Colgate karna hai. So it uses the language not brushing his teeth, it uses the language Colgate. So such is the brand value and it impact in the mind of the people. So you can say Colgate has got this. You can say moat. Another, when any, if we talk of any PSU bank, any public sector undertaking bank, any government bank, the first name which comes to mind is the SBI. We have, you can say, renovate. We want to renovate our house. We want to paint our house. The first thing which comes to mind is the Asian Paints. So this Asian Paints also has a moat or a brand value or a competitive advantage in relation to other companies in the paint sector. So these two things have to be kept in mind by the fundamental analyst before beginning this AIC analysis. So in the economic analysis, macroeconomic factors are considered. Macroeconomic factors, the first thing that comes to mind is the GDP, which I have just discussed. And in this, I have mentioned that historical performance of the company in the past and expectation in future. For example, now the quarterly fourth GDP growth rate is 8.4%, and the you can say uh, government or people are expecting that it will grow further in the next quarter. Growth of different sectors of the economy. The sectors which are likely to do well is, you can say, the schemes, various sectors under the PLI schemes, the sectors which are having the receiving the boost, infrastructure boost, and the sectors which are having, you can say, the impact of artificial intelligence or the robotics. So these sectors are also likely to do well. So if one narrowed down to industry analysis, these sectors are likely to do well. Another things which is mentioned is that trend in people's income and expenditure level. If you see the people, the high net worth people or the people who have more money in their hands, they are you can say the money is increasing all the way. So you can say that if you have observed through the various newspapers, the demand for luxury homes and the demand for luxury cars are increasing in comparison to the affordable homes and affordable cars. So this is what the trends in people's income and expenditure shows. Consumption, which I've discussed, if the GDP growth rate is good and likely to do well, then the consumption of the people will likely to increase because of the higher industrial production and because of more jobs and more income in the hands of the people. Obviously, the consumption will increase. Obviously, if the consumption increases, then industrial production will increase, sales will increase, profit will increase, it will create more jobs, people will have more money in the hands, and the standard of living of the people will be high. And this will give further boost to the GDP growth. And obviously, it will increase the share prices also. These factors we have discussed, growth rate of national income and the related measures. And this is the GDP growth rate. GDP plays a big factor. I will not repeat it further. And growth rate of industrial sectors. This all I have also discussed. Now, inflation. Inflation is also a very important factor. Uh, Moderate amount of inflation is good. Moderate amount of inflation is good. Why? Because let us take an example. A Cadbury's chocolate comes for rupees 10, say for example, and it increases to rupees 12, 2 rupees increase. So will the people will still be purchasing the Cadbury's chocolate, which he was purchasing for buying it for 10, for 12 now? The answer in most of the cases is yes, because it also has a moat or a competitive advantage in comparison to other chocolates. So people will still buy it in spite of the fact that the prices have increased from rupees 10 to 12. But and it will increase company's profitability also because now it is charging 2 rupees more. But if the inflation is too much, too high, then it is actually bad. For example, company increases the prices to rupees 15. Will the people still buy it? I think most of the people will now be reluctant to buy it because from 10 there is 50% increase to 15. The people who love chocolates will still buy it, but most of the people will likely to you can restrict itself. So it will have a you can say affect the profitability or dent its profitability of the company. So too much you can say inflation is bad, but moderate amount of inflation is good for the company. And obviously it will affect the economy also. It also gives a boost to the economy also. Monsoon plays also a very important role, especially in India and especially in the agricultural commodities, agri commodities, and the sectors related to agriculture. What are the sectors related to agriculture? We can say the first thing is come to mind are the pesticides, fertilizers. You can say the sectors will be on the cold chain, warehousing. These sectors will have a impact due to monsoon. There are various techniques also which used in the economic analysis. Anticipatory survey, which I've discussed, that it conducts an expert opinion on the part of the surveys conducted. An expert opinion is there on what should be the construction activities, what should be the expenditure on plant and machinery, levels of inventory, which all have a bearing on the economic activity. Because as I've discussed, that these are all interrelated. If the economy is likely to do well, if the GDP is likely to do well, it means there is more activity in the economy. The goods and there are more production of goods, there are more services, services sector is also active, production is more because there is more demand, more consumption from the side of the people. As the people are getting more jobs, they have more income into their hands. And specifically the sectors which are new, which are likely to will do well in the future. For example, electric vehicles, the sectors which are having artificial, the sectors related to artificial intelligence, the robotics, the virtual reality are likely to do well. So these are having in these all are interrelated, and also the future spending habits of consumers are also taken into account. And future spending habits are also, it also depends upon the projected GDP growth rate. If the GDP growth rate is likely to do well in future, the future spending habits, the fundamental analysts can make out, yes, the future in spending habits will be on the higher side. Now come to the barometer or the indicator approach. The next is barometer indicator approach, and these are three parts to it. That is leading indicators, roughly coincidental indicators, and the lagging indicators. So, what are the leading indicators? Leading indicators mean what is going to happen in the future. We leads it. For example, the GDP growth rate. The GDP growth rate is the leading indicator. The GDP growth rate is the leading indicator. And this GDP growth rate affects almost everything from industrial production to employment. From industrial production to employment. What is roughly coincidental indicators? Coincidental indicators means what is actually the present situation, what the economy is. And coincidental indicators, I will give you an example that actually a high personal income coincide with a stronger economy. If the economy is stronger, then people will have higher income, or higher income will lead to, I will repeat, higher income will lead to stronger economy, and vice versa also. Income is higher, people will likely to consume more, as we have discussed, and this will make the economy stronger because of higher industrial production, higher sales, higher profitability. Now come to the lagging indicators. So lagging indicators means which are affected by the leading indicators. Lagging indicators, you can say GDP growth rate and employment rate. If the GDP growth rate is less, it will lead to unemployment, or it will affect the employment to a certain extent, less GDP growth rate. And then the inflation and the supply chain disruption. If there is a supply chain, another example, supply chain disruption. So supply chain disruption will lead to inflation. As it is happening in most of the countries outside the world also, the inflation is happening not because of less demand, or there is inflation not happening because of the higher prices. The inflation is inflation is mostly happening because of the supply chain disruption, and the because of the war going on. The you can say the Ukraine war, Russia-Ukraine war, and the Israel-Hamas, and recently there is a conflict between this Iran and Israel. So because of this, the you can say smooth supply of goods and services are obstructed, restricted. So there is a supply chain disruption, and because of there is less supply, the prices of goods are increasing worldwide, and it is impacting every country, including India. So this actually is the main reason for the higher inflation. And the third aspect in this, we have covered economic model building approach. In this clear relationship between dependent and independent variables determined, we have discussed it that first of all, a GNP is calculated, gross national product. Gross national product is nothing but, you can say, GDP plus income from abroad. For example, you have made certain investment in USA, and in a company in USA, and you're getting dividend from that company. So this income is coming to India, and it will be added to the GDP. That's just a simple example. So GNP is nothing but GDP plus income received from abroad. So from this various factor, GDP is calculated, then GNP is calculated, and it is correlated with the, you can say, the GNP figures of a expert, and then you can say outside agency. And for this approach is developed that yes, how the economy is likely to fare in future. Okay, now come to industry analysis. Any question in this economic analysis, you may please ask if any question comes to your mind in this economic analysis. Otherwise, I will proceed to industry analysis. Okay, fine. Now just go through the industry analysis. Industry analysis, I have already given you a brief that uh, if the economy is likely to grow, it is not all that all industries will grow at the same time. Some industries will lag behind, but most of the industries are likely to do. So what are the industries which are likely to do well? The industries under the government's production linked incentive schemes, under which the government gives subsidies to those companies which are in the domestic manufacturing sector. Those companies which are having the infrastructure push, because of the government is going through construction of various highways, privatization airports, you can say railway stations, sea seaports, various other things. So Because of this, the Indian economy is getting an infrastructure push. Because of this infrastructure push, some of the sectors are likely to do well. For example, the steel sector, then comes the aluminium, woods, cement, the real estate companies, and the sectors which are in the artificial intelligence. Because now the future is artificial intelligence, virtual reality, electric vehicles. So these are the sectors likely to be given a push because of higher GDP growth rate. And what are the factors which affect the industry analysis? There are various factors. The first very important factor is the product life cycle. And this, you can say, plays a very important part, this product life cycle. There are various stages in this product life cycle. The first stage is the initial stage. The companies which are in initial stage, you can say artificial intelligence is still in the initial stages or infancy, especially in India. It is artificial intelligence, robotics, uh, electric vehicles, any other sector, driverless cars. This is also future. Driverless cars. So these sectors are in the initial stages. So if as a fundamental analyst, you think that these are the sectors which are having a good prospect and which are likely to do well. So it may invest upon it also, but it depends upon the investor to investor, how much risk he wants to take. Another is the companies which are in the expansion stage. So these type of companies which are in the expansion stage warrants the interest of the investors most. So which are these companies which are in the expansion stage right now? You can say electric vehicles also, because electric vehicles in the initial stages also some of the things, and some of the it is in the expansion stage also, because the government is giving a push to this sectors. And the various sectors which I have just mentioned, that is the expansion, the steel, the, you can say, the cement, and these sectors are in the expansion stage. And the other which are in the, some which are in the maturity stage, some companies. So companies which are in the maturity stage, you can say FMCG companies, food manufacturing companies, and you can say paints, etc. These are in the maturity stage. And some companies which are in the declining stage. So companies which are in the declining stage are the, you can say, companies which mobile keypad, mobile having, or these are also already declined, the BPOs and you can say CDs. So these are in the declining stages. So depends upon the stages, the fundamental analysis can make out that which industry to be concentrate on. So he would likely to be concentrate on this initial stages, depends upon the risk appetite of the investor and the companies which are in the expansion stage. The second aspect of the industry analysis is, first we have covered product life cycle. Second is the demand supply gap. So some of the companies which are having more demand are likely to do well. Demand supply gap. and the supply is less, this are likely to do well. I will give you an example. For example, in the period of COVID, the demand of masks and sanitizers have increased. So on this basis, the most of the and the companies which are in the vaccine making have did well actually, because the demand is more and the supply was less. Barriers to entry in a state of competition is more or less interrelated. The companies, any company which comes to your mind which are having barriers to entry, uh, the first thing which comes to mind, the mobile services. In mobile services, Jio is having the monopoly, and other companies, you can say Vodafone Idea and Airtel are far behind from it. Or you can say the barriers to entry in mobile services is very much, and the state of competition is also less. So because of this, the such companies are profitability is more, and such companies obviously are likely to do well, because since the because of barriers to entry, there is more demand of this. And the companies which are having less barrier to entry, this is less more barriers, and the companies which are having less barriers, or you can say having state of competition is more, is mobile companies. You can say mobile manufacturing companies, because there are various players. Foreign players are more, and Indian players also. You can name that. That is Vivo, Oppo, Samsung, Apple is already there. Indian companies also. So there are barriers of entry or state of competition in mobile companies are less. So if this barriers to entry is more, the company is, you can say, investors likely to invest in those companies. But where the barriers to entry is less, the investors likely to invest in those companies. And where the barriers to entry is, you can say, barriers to entry is less and a state of competition is more, in such companies, the investors are likely to invest it, depend upon how much profitability they are generating. So the competition is more, you can say the sales and profitability is actually distributed. Now come to cost condition and the important thing, government attitude. Government attitude I've already discussed. The infrastructure push given by the government and the PLI scheme of the government. And cost conditions and profitability. What is this? Cost conditions means while a fundamental analyst, while going through the industry analysis, will like to ponder upon the industrial sectors which are having more cost bearing, which are more cost, and which are having effect on the profitability because of the higher cost. So it will see the annual report, and the things which it likely to observe in case of cost is the raw material, labor, and overhead. Raw material, labor, and overhead. And the profitability, it will see? It will say the sales figure, will see the profit figures, okay, and the EPS also, return on capital employed, and return on equity. So these figures will company is, you can say, a fundamental analyst will likely to see in a particular. Now come to technology and the research. The technology and research in this field, the companies which are likely to do well are employing more artificial intelligence and robotics in the field. Now in India also, most of the companies, you can say the banking sector, the pharmaceutical sector, are employing artificial intelligence in their day-to-day operations. So not only services sector, but also the manufacturing sector, industrial sector, every companies is employing this artificial intelligence and robotics in the, can say, day-to-day business activities. Okay. Now, there are two methods in industry analysis which have already discussed, the regression analysis and the input-output analysis. Regression analysis basically finding out the, can say, dependent variable on the basis of a independent variable. For example, finding the sales figure on the basis of the GDP growth rate. So GDP growth rate is an, I can say, independent variable. On the basis of GDP growth rate, the sales is project. The sales is an dependent variable depending upon the GDP growth rate. So this is what regression analysis is. This is a statistical technique basically. In case of input-output analysis, in case of certain output, various inputs are used. For example, car. In car, what is used? You can say electronics are used also, steel is used, aluminum is used, uh, rubber is used, plastic is also used. So if the prices of any of these things, steel, aluminum, plastic, rubber, if anything is, you can say, affected, it will ultimately affect the price of the car also. So this is what the input output analysis is. Now we come to the final aspect of this, the company analysis. So what we have understood in the economic analysis and the industry analysis. In the economic analysis, the fundamental analysts just make an account of how the economy is doing and how it is projected to do. If he thinks that the economy is doing well and it is likely to do well in the future also, he can very well make out that yes, the most of the sectors in the economy are, you can say, giving a boost and they are likely to do well in the future, especially those sectors which are in the initial stage, in the expansion stage, and receiving a boost from the government. So, then it will narrow it down to industries. Which are the industries which are likely to do well? Those industries which are receiving a boost from the government, which are having, you can say, using latest technology such as using artificial intelligence, robotics in their day-to-day business activities, and which are in the expansion stage and the, you can say, the initial stages. So in summary, this is what economy and industry analysis is. Now the fundamental analyst narrowed its analysis to the company analysis. In company analysis, for example, the you can say fundamental analyst thinks that yes, the automobile sector, which are manufacturing electric vehicles, are likely to do well. So what are those companies in the automobile sector which are likely to do well? The company will uses various parameters. So let us discuss these parameters. First of all is the net worth and the book value. So net worth and book value, as you know, is nothing but the company's share capital plus the reserves and surplus. So what the just give me a second. So what this book value actually tells us? So book value actually tells us that if the book value per share is less, it tells us that yes, the share is cheaper to buy. But this is not a, according to some fundamental analysts, this is not a foolproof method because the book value depends upon the historical figures, means whatever figures which are there in the balance sheet of the company. So book value is there, but it is not a foolproof method. Now, the next thing which is very important is sources and uses of fund. I will take it as a uh, cash flow analysis or cash flow statement. And I will take briefly some time to just revise it so that you can recapitulate it again. Cash flow analysis. In cash flow analysis, student, there are three parts. First is cash flow from operating activities, CFO. Cash flow from investing activities, CFI, and cash flow from financing activities, CFF. So cash flow from operating activities, from the operations of the company. What is your opinion? It should be positive or negative? The answer is obvious. It should be always be a positive figure while you are looking into the cash flow statement of a particular company. Now, cash flow from investing activities. Cash flow from investing activities, positive, well and good. If the figure is negative also, the cash flow from investing activities, it may also be considered as good by the fundamental analyst. The reason is that if the company is investing activities is more, it means the company is a growing company. It is investing, but it should correlate with certain figures also. Cash flow for investing activities. That the it means company is investing heavily into investment, fixed assets. Company sales is also increasing, and sales is increasing because of sales volume, and not only because of sales price only. So this is the aspect which the fundamental analysts have to take care of. That even if the cash flow from investing activities is negative, also it may also be considered as good, provided the companies correlate with the company sales figure, higher sales volume, and obviously if the sales volume is higher, it will lead to higher profitability also. So, and the third aspect is cash flow from the financing activities. The cash flow from financing activities should be positive. It means cash flow from financing activity, the company is raising loans to finance its day-to-day operation. So cash flow from financing activities should be correlated with the cash flow from investing activities also, because whatever the company is financing, it is putting it into investment. And the overall cash flow from overall cash flow means cash flow from operating plus cash flow for investing activities plus cash flow from financing activities should also be positive. So these aspects should be taken care of by the fundamental analyst. And there should not be too much gap between the cash flow from operating activities and the net profit of the company. Company's net profit is, you can say, 100 crore, and company's cash flow from operating profit, company's net profit is showing 100 crore. Let us consider an example. And company's cash flow from operating activity is 20 crore. So will this be a feasible figure where the fundamental analyst will be inclined to invest in that particular company? The answer will be no, because it should correlate with its profitability is such high and cash flow from operating activities so less. It means the company has not much cash into its hand. So cash is also to be taken care of by the fundamental analyst while investing in a particular company. So there should not be too much gap between companies, the cash flow from operating activities and the net profit of the company. Now come to cross-sectional and the time series analysis. Cross-sectional, simple, it's a ratio analysis. We will discuss in the financial analysis, ratio analysis, and common size statements. Common size statements, you know that you can say sales figure are considered as 100, and every figure is compared in comparison to sales, because sales is 100, then you can say companies various expenses and various incomes are compared into the sales figure, or asset is taken as 100 and various assets are compared to the assets. So this is what common size statements are. So on the basis of the ratio analysis, the common size statements, the fundamental analysis make out that yes, what the company is doing and likely to do well in the future. Size and the ranking. Size and ranking also plays a big part. If you can go through the website of a particular company, you can see the size and the rankings of the particular company. Because in case of IT companies, for example, You know that the TCS is the leader. The Tata Consultancy Services is the leader. So it has more size, it's a more high ranking also. It is number one in the IT companies in case in India. Now come to growth record. Growth record. So what are the things which will fundamental analyst will consider, or you as a fundamental analyst will consider in case of a particular company? The growth record in terms of sales. So it should be about 5 to 10 years figures, minimum 5 years figures, 5 to 10 years figures. And the sales figure is increasing. For example, it is more than 10% for 5 to 10 years. Yes, the growth rate is more or less stable growth rate. Then net profit figure, 5 to 10 years figure. Then the company's ROCE, return on capital employed. Then the growth rate of company's equity, return on equity. So these are the things the company has to take care of. And another, the most last but not the least, the company's fixed assets. And more importantly, the capital work in progress. If the company's capital work in progress is high, it means the company is growing. It is investing more in fixed assets and production is taken place continuously. And obviously, it should correlate with the company's sales. Again, not because of selling price, but because of sales volume, the quantity of sales. So this is growth record. And then we come to financial analysis, one of the most important aspect of the company analysis or fundamental analysis. So in financial analysis, the fundamental analyst should first see the company's profitability. What are the things which will consider? We have already discussed this, that is company's net profit and sales figure, preferably more than 10 to 15% for the last 5 to 10 years. Same is the case with companies' return on capital employed, return on equity. Same is the position with the company's EPS. These things, the company profitability, while judging the profitability, these aspects a particular fundamental analyst should see that continuous growth rate in case of these, at least these five figures. Then it comes to then it comes to then it comes to liquidity. Liquidity, current ratio. So current ratio should be 2:1. Liquid ratio, that current ratio 2:1 means current asset should be twice that of current assets should be twice that of current liabilities. Liquid ratio 1:1. That is in, as you know, in liquid ratio, the inventories are deducted from the current assets. And another very important ratio while considering the liquidity of a company is the company's interest coverage ratio. There are various ratios also. This ratio, the fundamental analysts generally consider the company's interest coverage ratio. The company's interest coverage ratio should be low. It should not eat into the profits of the company. If the company has, for example, get a net profit of rupees 100 crore, and its 50 crore is consists of interest only. So most of its profit will be goes into the interest. So preferably the interest should be very low, and minimum it should be one third of the total profit figure. So if the company's profitability is, say, it is general figure depend upon analyst to analyst, but generally it is considered that yes, if the company's profitability is 120 crore, so it should not be more than 40 crore, so that company has sufficient buffer in hand because it has day-to-day expenses also, and it will retain certain profits so that it can utilize those profits into the investment opportunities. And then the company's solvency, a very important ratio which comes to mind is the company's debt equity ratio. So company's debt is equity ratio, it is not that company's debt equity ratio should be 2:1. The current trend is that every companies, including the manufacturing companies, are reducing their debt in their balance sheet. So it should be at least 50% or even lesser than the total amount of e- equity. So debt should be less, so that there should not be too much burden on the company. And last and the most important is the company's cash flow state, which I have already discussed. So these things the fundamental analysts have to take care of while going through the financial analysis, profitability, companies, net profit, sales, return on capital employed, return on equity, EPS for the last 10 to 15 years, more than 10, for the last 5 to 10 years, more than 10 to 15% at least on a consistent basis. Liquidity company's current ratio should be good. Current assets should be twice that of current liabilities. Liquid ratio, that is, if we deduct the inventories from the current assets, that should be at least equal to the company's current liabilities. And then the interest coverage ratio, it should be as less as possible, preferably not more than one third of the company's EBIT, company's earning before interest and tax. Solvency, debt equity ratio, debt should also be low, so that the company is no, it should not face the risk of you can say a default risk in the future. So debt should be as low as possible, preferably 50% of the equity. Again, it depends upon the analyst to analyst, because in case of some manufacturing companies, because of the heavy capital expenditure, the debt is more. So it depends upon company to company also. Company's cash flow statement, as I have discussed, the company's cash flow from operating activity should always be positive. Company's cash flow from financing activity should also be always be positive, and company's cash flow from investing activities can be negative, provided the amount which has been raised through the financing activities are utilized into the investing activities. And investing activities means whatever has been investing through in various investment, fixed asset, whatever it is actually reflected in the company sales figure also. And sales figure not because of, or not only because of sales price, but also because of sales volume. That is, company's quantity of sales is also increasing because of this increase in uh, company's you can say capital expenditure. So this is the company's financial analysis, and this then come to competitive advantages. So what the company's competitive advantage? Company has competitive advantage. We have already discussed that the company's moat, or so these companies have basically a competitive advantage in case of certain other companies. You can say the company which comes to mind, Asian Paints, which have a competitive advantage in the paint sector. You can say SBI, which have a competitive advantage in case of PSU banks. Okay. Now comes to another very important aspect of this fundamental analysis in company analysis is quality of management or management analysis. So one has to be very fundamental analyst has to be very careful in this management analysis. So I will take some time to again take this management analysis or analyzing the quality of management. So first of all, when one is doing a management analysis or assessing the quality of management, do a he wants to do a background check. Background check. Now, background check of what? Background check about who are the company's promoters. Who are the company's promoters? Who are the company's independent directors? How many independent directors the company has? Okay. Next, it will see the company's management succession plan. Company's management succession plan. That yes, the whatever the company's can say higher officers, the company's CFO or company's you can say chief operating officer or other officers are groomed or trained to become the future CEOs, or the company has good backup so that if the current CEO retires or the current CEO resigns or go out of the company for whatever reasons, the backup is there in the company to have a competent person at the helm. So this also has to be considered by the fundamental analyst. So management succession plan is very important. You can some of the companies, for example, TCS, and in case of Infosys, they have a good management succession plan. Now, another important factor is salary of promoters versus net profits. Student, this is also a very important factor, salary of promoters versus net profits. If the salary of the promoters are high and company is having good profitability, that is perfectly okay. But in case of some companies, as happened in the case of ILFS, that is Infrastructure Leasing and Financial Services Limited, the company's profitability was reducing, even the company's exercising loss, but the salary of the promoters was increasing. So that should not be the case. If that is the case, that is a red flag. So salary of promoter should be commensurate with the high net profits of the company. Another aspect is the project execution, which also have a bearing on the capability of the company. If the company has certain projects in hand and the company is able to complete those projects in time, it signifies the efficiency of the management. So project execution is also a very important part which the fundamental analyst have to see while going through the quality of the management. Consistent, consistent dividend. This is also very important. Many companies are or actually do pay consistent dividend year on year basis. It is not necessary or compulsory on the part of the companies to declare dividend every year. It is not compulsory at all. But some companies, in order to have a good impact on the minds of the investor, do generally pay dividend on a consistent basis, on continuously. Some of the companies which comes to mind, which I have discussed it earlier also, that is Asian Paints, you can say Dabur, you can say ITC, various IT companies, TCS, Infosys generally pay good amount of dividend to the investors. And another thing which I have already discussed, that sales growth. That is, sales growth, is not only because of sales price. Sales growth should mainly because of sales volume. The quantity of the companies should be increasing. If the company is employing fixed assets, its production is increasing, so proportionally the company's sales should also increase. The production is increasing. So sales volume is the important criteria which the management, you can say, the fundamental analyst have to see while going through the management analysis. So these are the things in case of, you can say, management analyst, the fundamental analyst has to see. This is a very important thing, not any less than the financial analyst. So a fundamental analyst has also to go through the financial analyst and also consider the management analysis also. And from these two, it should come to a conclusion that whether it is feasible to invest in such a company, whether the company is good enough to be considered as an investment option. So, quality of management we have considered this aspect. Now come to corporate governance. Corporate governance and regulation, these are one of the same thing. So corporate governance basically comes under the company's LODR regulation, that is listing obligation and disclosure requirement. I will give the full form here. Companies listing obligation and disclosure requirements. So this is the SEBI's listing obligation disclosure requirement which the companies have to comply with from the time to time. Because the timely submission of the company's financial statements, various compliance requirements, shareholder patterns, all this comes under the company's listing obligation disclosure requirements and also the you can say Companies Act 2013, Securities Contract Regulation Act, SEBI Act also. So all these regulations have to be complied with by the companies. For the corporate governance requirement also, because this is related to corporate governance. And if the companies have outside operations, the company's FEMA has to be taken care of. That is Foreign Exchange Management Act. So these all are important also, and the fundamental analyst has also to see that the company, what are the regulations which are applying to a particular company, and whether that company is actually complying with this various, you can say, requirement also, and whether the corporate governance requirement is good enough. And lastly, the company's location and the labor management relations. If you see that, I have discussed is also company's Manesar plant, the Maruti Suzuki, there was a dispute, that is dispute between labor and management in the Maruti Suzuki's Manesar plant. So these sort of situations should be avoided by the management because earlier it was not that closely monitored by the investors, but now the investors are monitoring it very closely that the labor management relations of the particular company is good. So this is not also now an important factor to be considered by the management, by the fundamental analyst. Now come to company analysis in case of pattern of stock holding, existing stock holding. This is also an very important factor, and it is also has to be considered due. It has to be given due consideration by the fundamental analyst. Let us say, First is promoter shareholding, then FIIs, foreign institutional investor, DIIs, domestic institutional investors. What are their shareholding pattern? And what are the changes in this shareholding pattern that has to be considered by the fundamental analyst also? And one of the main aspects to judge whether the company is likely to do well or not is that whether the promoter shareholding is reducing. And if this is reducing by a substantial margin, then that should be considered as a red flag. For example, the promoters, you can say, holding is 70%, and within a few months, it has reduced its holding from 70% to 60%, then it should be considered as a red flag because such substantial reduction of the shareholding indicates the company is not, that there is something wrong in the company and the company is not likely to do well in the future. That's why the promoters are reducing the shareholding. So that has to be considered very closely by the fundamental analyst, the pattern of the existing share stock holding and especially the promoter shareholding. What changes are taking place in the promoter shareholding? And last but not the least, marketability of the shares. And marketability of the shares will be higher if the company's share prices are higher. And it depends upon the various factors which we have discussed above, especially the company's good financial and fund statements for the last 5 to 10 years. And it also depends upon the quality of the management also. And the techniques which are generally used in this company analysis is correlation regression analysis, trend analysis, and the decision tree analysis. The correlation and regression, I have already discussed. It is applied in the case of industry analysis also. So correlation is basically what is the correlation between the company's profitability, correlation between the company's profitability and the profitability of the industry. So, for example, a fundamental analyst can compare the profitability of, for example, Tata Steel with the profitability of the steel sector. Or fundamental analyst will compare with the profitability of Tata Consultancy Services with the overall profitability of the profitability figures of the IT sector. So these correlation can be taken place by the fundamental analyst, and regression also, that is we have already discussed, that is finding an, you can say, dependent variable on the basis of an independent uh, variable. And trend analysis basically related to these, because if the company is doing correlation regression analysis on an year-on-year basis, so for certain number of years a trend is established. So this is what trend analysis is. For the 5 years, 10 years, the trend is established that way, yes, the company Tata Steel is showing a good profitability in comparison to the steel sector. For example, if steel sector is doing well, then Tata Steel is doing even better. So this is what the trend analysis tells us. Decision tree analysis we have discussed in detail. I will not go into it again. So decision tree analysis basically giving probability to these things, that if what is the probability of the company's profitability increase for 20% in the next 5 years, 10% in the next 5 years, 5% in the next 5 years. So on this basis, the fundamental analyst comes to a conclusion that whether the company's profitability is likely to increase in future or not on the basis of decision tree analysis. So if you have any queries into this in decision tree analysis, you may ask, but I will not delve further time into it. I have discussed it in the brief. But any question, please feel free to ask. Certain warning signs I have already considered is, but some of the main, I will summarize it. Some of the 3, 4 warning signs which a fundamental analyst as an investor should consider is that if the company is giving too much money to its subsidiary, and the objective of the holding company and the objective of the subsidiary company does not matches, So it means there is a red flag. For example, a holding company is taking loan from a particular bank, for example, State Bank of India, and it giving that money to that another subsidiary company, and the subsidiary company is not is not doing any business, or its business is objective not aligned with the holding company, then that is a red flag. So these are some of the things which a particular fundamental analysis has to be considered. And another thing which I've also discussed, very important, huge investment in fixed assets is takes place, but it is not reflecting in the sales figure. Fixed asset is increasing, but sales is not increasing on that amount, or it is at this level. Investment in fixed assets is at this level, and the investment in sales is at this level. It means it is not commensurate with this, the investment in fixed asset figure with the sales figure. So the company's production capacity will not increase because the sales is not increased. One. So this is actually a warning sign. Why so much capital expenditure is there, and it is not reflecting in the company's production and sales. And another thing that the company is having subsidiaries in tax-free havens. There is Cayman Island and all such. And why the companies are having subsidiaries in such Cayman Island? Because it does not want to maintain its books of account. Because in such countries there is no requirement of maintaining books of accounts. But why the company wants to do that? Having subsidiaries in those you can say countries where there is no requirement of, you can say, maintenance of books of accounts. And another red flag is that this is mentioned in this point. The company has unpaid tax liability. It has unpaid tax liability, but it is regularly paying to related parties. So company has unpaid tax, areas tax, but it is paying to regularly paying to related parties. This is also a red flag. And last but not the least, very important, that is the abrupt or sudden resignation of the auditor for the company. No auditor wants to resign in between or in the middle of the particular financial year. So if any auditor has taken this drastic step of resigning during the mid of the particular financial year, then this it should also be considered as a red flag by the fundamental analyst. So this is what about the fundamental analysis. So I will take a brief moment to discuss this technical analysis, and then we'll take a brief break of 10 to 15 minutes. Any queries in fundamental analysis, please feel free to ask. Even if I have started as technical analyst, but if anything comes to your mind in case of fundamental analysis, please ask. Okay. So basically, what is a technical analysis? And what is the difference between technical analysis and fundamental analysis? In my lecture, I have given a brief example to show that what is the difference between this technical analysis and fundamental analysis with a practical layman example that a particular person went to a particular restaurant, and he goes to there are very numerous restaurants. He goes to 4 or 5 restaurants, eats some amount of sample food, and select a particular restaurant, enjoyed his meals, and get out. And another person who did nothing but simply sat in a you can say bench and observes that. He observed that in a particular restaurant, most of the footfall was highest. Most number of people are visiting, and when the people are coming out, they have happy faces, means they are liking the food. So when going to that went into that particular restaurant, enjoying food, and come out of that. So the former one is a fundamental analyst, and the latter one is a technical analyst. So the technical analysis involves more, you can say, more put, you can say in simple language, I would say put more emphasis on human psychology, more emphasis on human psychology. Human psychology is there in fundamental analysis also, but in case of technical analysis, the human psychology works more. Why? Because in technical analysis, the technical analyst based his decisions on the basis of various graphs or charts and the price movements which have appeared earlier. And on that basis, he makes a decision that if a particular trend which have happened earlier likely to happen in future also. So on this basis, the fundamental analyst generally proceeds. So what is a technical analysis? Technical analysis basically uh, analysis of the share price movements based on a study of graphs or charts on the assumption that share price trends are repetitive. The share price trends are repetitive. Means whatever trend has appeared in the past is repeat in the future. For example, I am giving an example. I will, because you have gone through it, so you will able to correlate better. For example, it is stock prices is showing a downtrend for some time. And then there is a prominent green candle appears. This is a green candle. So what is a green candle? As we have discussed that it shows that the closing prices of a particular stock is more than the opening prices, or it shows you can say, bullish, you can say, signal. It signifies a bullish signal. So this type of trend, if appears, it may be considered that yes, after that the prices, you will see the fundamental technical analysts see that yes, the prices have increased after that. So again, after 2, 3 months, say this type of situation occurs that there is a downtrend and there is a green candle appears. So technical analyst can say that yes, the earlier the trend was that when this type of prominent green candle appears, then the share prices shoot up. In this cases, they also will take likely to take a similar decision. So yes, the prices will likely to do well, and let us buy at this stage. So it depends upon the technical analyst, but I'm just giving an example that share trade prices trends are repetitive. These trends likely to appear in future also. Whatever trends appeared in the past are likely to appear in the future also. And investor psychology plays a very important part. The investor psychology. Investor psychology is a very important part because how this investor psychology works. If a particular stock shows an uptrend, for example, this stock is showing an uptrend going up, most of the investors will think, yes, the share is going up. Let us buy at this stage. Even if it's showing a substantial uptrend at this stage also, and even at this stage also, the people will buy because most of the people are buying. So this psychology works for most of the time. If the share prices are going down, so investors see that it is going down. Let us sell it. So he will not say sell it at this stage. When most of the people are selling it, he would also wants to sell it. So by this, the investor psychology works, or the herd mentality works in case of technical analysis. So I will go further into this technical analysis. I will take the assumptions principle and I will briefly wind up the technical analysis portion. Any doubt, any queries which comes to mind, please feel free to ask during the course of this particular, you can say, lecture. So this I'm taking a brief, you can say, a break of about 10 to 15 minutes. Let us come back at about, you can say, 8:40. So thank you so much. Okay, thank you. Okay, students, welcome back. Any query which comes to your mind? One of you has been asking that in practice, how far these factors do affect share price. For example, current volatile share market. This will be, you can say, clear to you during the course of my lecture also. This question related to these fundamental analysts or technical analysts? You can specify that. If your question is relating to fundamental analysis, then I will just elaborate it on this factor. Both. Okay, fine. So I will reiterate that in fundamental analysis, basically on account of economic, industry, and company. Okay. Now, on the basis of economic analysis, generally the decision do not, the fundamental analysts do not take the decision whether to invest in a particular company. The next stage is the valuation. He takes the valuation of equity shares and then he calculates the intrinsic value. And on the basis of the intrinsic value, he arrives at a decision that whether to purchase the shares of a particular company or not. And whether the share prices, our current share prices are volatile or not, this is actually a short-term phenomena. One of the another basic difference between the fundamental analysis and technical analysis that the technical analysis is basically is short term. You can say emphasis of the technical analysis is on short term, and the emphasis of the fundamental analysis is on long term basis. So the current volatile share market prices is more related to technical analyst. Okay, because on the basis of all this economic industry, the company, and after doing the valuation, the fundamental analyst basically wants to invest for a long period of time, 1 year, 2 years, at the most 5 years to 10 years, for a long period of time in a particular share. But the emphasis of the technical analyst is to invest in a shares of a particular company on the basis of certain trends, price trends which have already appeared in the past, on the basis of take a decision and make a short-term quick profit. That is the you can say basic psychology of the technical analyst. So this aspect will be clear to you when I will further this delve into this technical analysis portion. Now, there are certain assumptions in the technical analysis. The first assumption is the market value of stocks depend upon the supply and demand for a security. If the demand for a particular security is more, then the market price will obviously be higher. This is the first assumption, and it is self-explanatory, and it is must have been clear to you also. I will take the PPT so that it will be in front of you, so you can correlate it better. So market value of stock depends upon the supply and demand for a particular security. I think this is self-explanatory and not to explain further. Then supply and demand are governed by factors which can be rational factors as well as irrational factors. Why the demand is increasing? Why the demand for some time ago, the demand for PSU, the demand for PSU bank stocks, the demand for PSU bank stocks, the demand for PSU bank stocks was high. Therefore, the stock prices were high. Okay. What was the reason behind it? The reason was that NPA, non-performing assets, were reducing. Okay. That's why the PSU bank stocks were high. So most of the investors will likely to invest in such companies because we see that yes, they heard from the newspapers, yes, the companies, most of the banks net non-performing assets were reducing. PSU bank stocks are at an all-time high. Let us invest in the shares of the PSU bank stocks. These are the rational factors. These are rational factors. Sometimes there are irrational factors also. Irrational factors basically apply in the case of the small caps, that is the companies which belong to the small cap category, or the, we can say, those companies which are uh, after 250, because for the first 100 companies which are listed are called as large caps, and from 101 to 250 are called mid caps, and after 250 it is called the small caps. So it is generally happen in the case of small caps that irrational factors also plays a part. uh, Irrational factors maybe might be many. A small company, a small company which is actually, you can say, logistic company, a small cap company, logistic company, has employed artificial intelligence, AI, into its day-to-day operation. Share prices beginning to shoot out. Share prices shoot. This is the rational factor. But sometimes the investors do not, you can say, consider those factors. They see that, yes, whether the AI application which has been used actually is actually feasible for the long term or not, or actually is of any use to that company. There's such type of analysis. The you can say most of the investors do not take place. See that the other investors are investing in such a small cap company which is in the logistics sector using AI. So let us invest such companies. Some of your friend have told that yes, this is a good company. चलो इस company के shares में invest कर देते हैं. So you also invest that. So that is the irrational part. So sometimes the investor behave rationally because they are knowledgeable investor. They see that the yes, the most of the banks are reducing their non-performing assets. So it is a good indication that the banks are likely to do well. Their profitability will increase. So let us invest in the share prices of such companies. So that is a rational factors. Sometimes the investor act irrationally. Yes, some of the investors are investing. Let us invest. So that is the basic psychology. This is a herd mentality. Other investor are investing, so let us invest it without having any knowledge. So sometimes the investor acts rationally as well as irrationally. Then the stock prices generally moves in trends which continue for a substantial period of time. This is very important. The share prices moves in trends because for certain period the stock prices shows an uptrend. This is an uptrend. Or certain period of time they show an downtrend. So share prices generally moves in trends. I will show you an example, practical example, so that you will able to correlate this with this. I hope this is visible to you. Ashok ji, visible है ना sheet? Okay. See, this is Nifty. This is weekly trend. You see the stock prices are moving in trend. This is showing an uptrend up to this. Then there is a downtrend. Uptrend for a brief period, then downtrend, then again an uptrend. If you see the date is coming below it, that is 30th of October 2023, below in black. And this uptrend is continuing from 30th of October 2023 to 8th of January 2024. About about 3 months, this uptrend is continuing. So the stock prices generally moves in trends. And technical analysis relies upon chart analysis, which show the past trends in stock prices. So whatever I have showing is the past trends. Now move forward. Uh, what are the you can say principle of technical analysis? Technical analysis is based on the following three principles. First principle is that very important. The market discounts everything. Market discounts everything means discounts not only the past prices, past events, also, but also the present events and also the future, which is likely to come. For example, recently the you can say the stock prices are were falling in the last week because there was a jitter, whatever uncertainty regarding the election. So market has discounted it that. Other factors why the market was declining during the past week is general uncertainty in the global market. The first is the inflation. First is the inflation in USA. Since there is an inflation is in USA, the interest rate is high, and there is a further expectation that the interest rate will be higher. So this will increase the yield also, or the return which the investor will get. Since the investor is getting more return in the USA, they will likely to exit. This is a general perception that exit from the Indian market. So that is why the market also discount that. Yes, the position in the USA, because whatever is happening in USA, it affects the whole world, including India. Another factor which the market discount is the deflation in China. What is happening in China? China, the industries are not doing well. The prices are lower, unemployment rate is high. If the unemployment rate is high, everything is interrelated. If the unemployment rate is high, the people have less employment. So people will have less money in their hand. So people will buy less. If the people will buy less, there is less industrial production, there will be generally less production. If there is less production, there will less profit, sales and profitability. So company will expand less and this will lead to more unemployment. So if there is consumption is less because of people have generally have less income in their hands or because of non-employment. So the demand for goods will be lower. Demand for goods and services, demand for goods and services will be lower. So what will be its effects? The demand for goods and if the demand for goods and services will be lower. If the demand for goods and services will be lower, it will import less. The China will import less. And as you know, the China is the second largest economy in the world. So it will import less. It will affect the market of the entire world also. Because now the other countries will not be able to export much to the China because their consumption is less, their demand is less. So their production will be less, so it will be affected other countries also. Because whatever, let us take the example of India. Now there is less demand from China, so Indian companies will import less. If they import less, they will have to then their production will also be reduced because of the less import, and that will be effect on the Indian market also. Because as you know, the production is less, then there will be entire thing is interrelated profitability will be less and sales will be less. So the market has discount this aspect also. So what mainly the aspect which the market have discounted or the market have considered is the deflation in China and the inflation in the USA and also the present jitters in the market because of the election which is going on. Okay. So this is a very important factor and principle of the technical analysis that the market discounts everything, not only the past, present, also the future also. Now the prices moves in trends, as I have already explained, that the prices moves in trends, which I have shown that from 23rd October 2023, from this 30th October 2023 to this 8th of January, about 2.5 months. This is showing an uptrend. The market is going in a trend. So generally, the market moves in trends. It does not always take place. The market shoots up just like this and it falls just like this. It does not happen. Market moves slowly in this way. This is an uptrend and it falls down in this way also. So this way the stock market actually behaves. So this is also an important factor. Prices moves in trends and history tends to repeat itself. Whatever happened in the past is likely to happen in the future also. So main emphasis of the technical analysis to see the past trend, that yes, this type of trend has appeared in the past. So it is likely to repeat in the future also. Let us see it. Let's see it with an example. I have given it in my in this discussion also. So let us see it practically also. Uh, See, this type of trend, if you see this green candle, you are able to see green candle. Again, I repeat, green candle shows that uh, this is a bullish candle. That is, the closing stock prices are more than the opening prices. Okay. For example, if the opening market price of a particular company opened at 100 and it is closed at 120. So it shows a bullish trend. So this is a green candle, a bullish candle, and it is after you can say a downtrend. A downtrend. This is showing a downtrend. And if when this candle appears, most of the people think that it is a prominent bullish candle, because if it is opened at a higher rate. I will explain the Japanese candlestick also, and I will explain it here. This region, the stock price opened. It is opened at 16,976. If you see on the right hand side, it is appearing in the black 16,976. And this is the closing. Closing, it is showing in the above also, this closing and opening, and it is closed at 17,359. So opened at 16,984 and closed at 17,359. A substantial uptrend. So this type of candle when appears, most of the people likely to buy. So they are buying it. See, it is actually increasing, showing an uptrend here. From this 27/3/2023 to this 17/7/2023. This is an uptrend. Again, I will just see a candle like this. See here also. See, this is green candle. This is a downtrend up to here. And then this prominent candle. If you see 7/3/2022 appearing below, this is a prominent green candle, a bullish candle. Very prominent. So in this, the investors see that there's an opportunity. Yes, the prices will likely to increase in future, because there is no 100% cannot be prediction cannot be taken place. So technical analysts see this. Yes, this is an opportunity. From this, the market will go up. So from this, the purchase take place, and see there is a uptrend for some time. So I want to say that the history tends to repeat itself. Whenever this type of candle appears, and this appearance takes place after some time, every 2 to 3 months, 6 months. So from this, on this, the investor takes certain decision on this basis, because they know that the prices moves in trends and the history will tend to repeat itself. This type of trend will appear in the future. At that time, the technical analysts take action. Okay. Now come to the theories of technical analysis, and this is Uh, what is the Dow Jones theory? Dow Jones is known as the father of technical analysis. So, and he classifies the stock market into three trends. There is a primary trend, there is a secondary trend, and there is a minor trend, that is daily fluctuations. And primary trend is for a certain period of time, that is for 1 year, 1.5 years. Secondary trend is for certain number of months, that is 3 months to 6 months. And daily trends are daily fluctuation. On this basis, the technical analyst takes a particular decision. So here, see, there is a particular trend. I have give this example also, 27.3 from this. Let us take a earlier example which I have taken from this. That is 30/10/2023 to this. 2 months, 8/1/2024. This is a particular trend. And this is actually a secondary trend. Primary trend is, you can say, this is a long uptrend. From this, it shows an uptrend. If you see that, there is a long uptrend from this date, from, you can say, 2022 to up to this 2022 to 4/3/2024. There is a actually a uptrend from this. You can say from this 2022 from this date, you can say August 2022. So August 2022 to from this figure, from March 2024. So this is basically a primary movement. This is the primary movement. Secondary movement you can take in a short period. That is, this is a secondary period from this date to this date. This is a secondary movement basically. Okay, and these are daily fluctuations. For example, this will take to daily fluctuation. These are daily fluctuation. This 10 figure, this, you see that is 10th of May 2024. This is the chart on 13th of May 2024, and this is on 14th of 2024. So these are the daily trends, minor trends, or the daily fluctuations. So on this basis, the technical analyst takes decisions. Now come to Elliott wave theory. Elliott wave theory, there are two things, that is impulsive patterns and corrective patterns. Elliott wave is also, you can say, a very prominent figure, and his theory still stands true today. He explains certain trends, that is impulsive pattern. Let us see the impulsive patterns. See, if you see that the prices go up, it comes down, but it does not breaches this previous low. This low does not breaches this previous low. Then it increases and it breaches this previous high. This high breaches this again comes low, and this low does not fall below this low, and this again breaches this previous high. This. So there are two ways. This is actually a up to this. This is an impulsive pattern. Impulsive pattern means most of the investors will likely to buy at this stage. Yes, this portion, it is breaching this previous level. So let us buy. Then again, if they see that yes, this is again breaching this previous level. So let us buy. So this is giving a buy signal to the investors. Then corrective patterns, it comes down. It again goes up, but see that this time it does not breach its previous high. It comes lower to that. Then again it comes down, and it comes down from the previous low. So at this level, the technical analysts see that there is an opportunity to sell, because now the bear are active and it is now pulling the stock prices down. So at this stage, most of the technical analysts want to sell. So this is basically show a corrective pattern. This is basically show a corrective pattern. This is what Elliott wave theory is. Any questions you may please ask during this lecture. Now come to random walk theory. Now, what random walk theory is? Random walk theory is a altogether different view from the Dow Jones and the Elliott wave. Random walk theories believe that the share prices cannot be predicted. And they say that the price trend in the market discounts everything to how the share prices will be predicted. This has been taken in detail in efficient market hypothesis, in which I will take an example also. So this is random walk theories is basically are followers of efficient market hypothesis, according to which share prices cannot be predicted. Now come to line chart. Line chart, you know that this is the basically on the basis of line, is closing prices here. The dots where the prices are closing prices. So on this basis, a particular trend is established. On this, an uptrend is established because we see that yes, it is going up. So it shows the closing prices. This is basically a line chart. Under bar chart, as you know, uh, this is the lowest point, lowest price. This is the high, for example, and this is the opening, and this is the close. So what it means, the market opens at this low, it reaches a high here, it opens here, it reaches a high, it again comes down, and again it goes above and closes at here. So basically, in bar chart, all this you can say figures are shown. In Japanese candlestick, I will take in a slightly detailed manner in which it will be more clear to you. Now come to Japanese candlesticks. So Japanese candlestick is just like a bar chart, but people prefer Japanese candlesticks in comparison to the you can say bar chart because of the it is more visible, it is more clear, and that basis certain quick decision can be taken. So it is more user friendly, Japanese candlesticks, and it is widely used by the technical analysts all over the world. So let us take a candle. Let's take this as a candle. So let us say the market open here. The market of a particular stock close here. Okay. And this is basically a green candle. What is a green candle? Green candle is basically a bullish candle in which the closing prices are higher than the opening prices. It shows a bullish trend. It is a high and it is a low. So let us say the market, the particular stock price opens at rupees, opens at 100. Opens at 100. Now the bulls give their power and gave its full swing and it reaches the high. It reaches the high at 120. From 110 to it reaches at 120 because bulls are active. There is active buying. लोगों ने खरीदना शुरू कर दिया. But suddenly then the bears are active again because they see that now the stock prices reach 120, let us sell it and pocket a profit of 200 because it opens at 100, reaches at 20. So let us pocket a profit of 20 rupees. So most of the now the sell people will be likely to sell. So by selling this, I'm just giving a hypothetical example. So by selling this, it again comes down and reaches a low of, let us say, 90 rupees. Reaches a low of 90 rupees. But now the bulls are again active. So let us say there is a good prospect. Now that the share company is likely to do well, let us purchase it. So bulls were likely to purchase it. And then it closes it at, say, 115. Okay. So this way the Japanese candlesticks works. So it opens at 100 and and it reaches a high of 120, then because of active selling, it comes down at 90 and again closes at 115 because of some active buying by the bulls in the market. So this is what Japanese candlestick is. This is a green candle in which closing is more than opening. Vice versa is the situation in case of red candle. If there is a red candle, it means the opening price is more than the closing. For example, if the market opens at 100 and it closes at 90 rupees, so it will signify a red candle. It means the bears are active on that day. There is more selling on that day. It shows a bearish indication. It gives a bearish indication. So now point and figure chart, I've already gone through this. If there's any question, you can uh, please ask on this. Now I would will go further to market indicator. That is okay. Uh, one query is come and whether Elliott wave is true for long term or the short term. Uh, I would say that the major emphasis of the technical analysis short term, generally for it can be for 1 year, 2 year, 3 years also, but basically it is for a short term trend. There are some players who trade on a daily basis, some are for a few weeks and some for some months or up to 1 year. So basically the emphasis of the technical analysis for a short term. So Elliott wave theory uh, points to that concept itself. Okay. Now come to breadth index. So breadth index basically tells about advances minus decline. Advances minus decline upon number of share trend. Okay, so if there is a more gap between advances and decline, it means the market is volatile. Volume of transaction. This volume of transaction is very, very important. If a technical analyst, before investing in the shares of a particular company, wants to give a proper look to the volume of transaction. If the share prices are increasing, showing an uptrend, good, well enough. But if the volume is not good enough, then he will likely to skip it, likely to avoid it, because the share price increase may be on account of some other factors. But if there is a prominent increase in the share prices and increase in the volume also, that gives a good indication that yes, the bulls are serious in this case, and there is a likely possibility that the stock price of that particular company is likely to go up. So volume of transaction is very, very important. Confidence index. Confidence index is basically shows that the ratio of high grade bond yields to the low grade bond yields. So if the ratio is higher, it indicates a good opportunity to invest in the stock market. As you know that if the yield is higher, means there is a gap between high grade bond yield and the low grade bond yield is lower. It means the you can say yield is higher. So if the yield is higher, the you know that there's an inverse relationship. The yield is higher, then the value of bond will decline. So because of this, the investor will most likely to you can say invest in the stock market. Will likely to shift into the stock market. So a rising confidence index is precedes the rising stock market, and if the confidence index is low, because if the bond yield of high grade bonds are low, then the you can say people will be less inclined to invest in the stock prices as the value of bond will be higher. Now come to relative strength analysis. In the relative strength analysis suggests that the price of some securities will rise relatively faster or decline more slowly in a bear market. That is basically the indication. That is, here it is given that uh, prices of some securities will rise relatively faster in a bull market or decline more slowly in a bear market. For example, some time ago, the I will give you an example. Hindalco. Some time ago, Hindalco was showing this trend. It was rising relatively faster in a bull market in comparison to other shares. So this shows the relative strength analysis of a particular stock. Odd lot theory. Odd lot theory means a contrary opinion because what happens is that most of the investors which invest in the stock market invest on account of some tips. That is, their friend told this a year, yes, you buy the stock of such companies, let us buy it, or your relatives, or there is some news in the newspaper, or there is some, you can say, an expert opinion on a particular news channel. On that basis, one purchases it. But that is basically a herd mentality, and many investors like follow this practice without having any knowledge of the technical analysis. So this is the odd lot theory. So experts are likely to, you can say, therefore they are of the opinion that uh, generally an average person is usually wrong because they invested in the stock market without any proper research and analysis. Now come to support and resistance. Friend, this is a very, very important part of this support and resistance. So what this is support and resistance? Support means, as the term indicates, giving a support. It means the stock prices will not fall below from this. It provides a support. And resistance means it provides a resistance to go up. Means it is giving a resistance. Or in other words, the stock prices will not go further from this. It provides a resistance at this level. The stock prices will not go beyond this. And support, it is providing a support here. Means the stock prices will not fall from this. So this is what support and resistance is. So what will be the decision of the investor? Since the investor knows as a technical analyst, no expert technical analyst knows that the prices will not go up from there. So will he be likely to buy or sell? For example, the stock prices have reaches here rupees 100 resistance level, and he knows that the prices will not go further. Will he likely to buy or sell? So the decision will be to sell because now on he will not get any profit from a continue to invest in it. And the decision if it reaches the support level, for example, the support level, the resistance level is 100 and the support level is, for example, rupees 60. So at support level, will the technical analyst will likely to buy or sell? He will likely to buy. Why? Because he knows that the share prices will not fall below this, will not fall below 60. So let us purchase at it at 60 so that it may increase in the future. So this is the significance of the support and resistance, and it is followed very widely by the technical analyst. So this way the support and resistance works. Let us say that here it is when increases. So here it is creating a resistance here. The share prices are not going up beyond there. Let us say it is at 100. So whenever it reaches 100, it falls down. Whenever it reaches 100, it falls down. It falls down, falls down, falls down. So at this level, the investor will be likely to sell because it knows that it will not get any profit by continuing to further investing in it. But when it falls this support level here, it is the support. It provides the support so that the share prices will not fall further. Let us say the support is 60. So investor know that whenever it reaches this level, it goes up. It reaches this level, it goes up. It reaches this level, it goes up. So this creates a support. So at this time, the investor will likely to buy because they know share prices will not fall further and it is profitable to invest in it. So what this proves? It proves an important principle of technical analysis. What is that? That the history tends to repeat itself. That whatever happens in the past happens in the future also, and prices moves in trends. Prices moves in trend. So whenever this reaches the resistance level, the investor know that yes, it will not go beyond that because it happens in the past also. So the technical analysts follow this principle that past trends are likely to follow in the future also. And whenever this reaches 60, the technical analysts know that it will not fall below 60. So let us buy at this level. So this is what is the concept of support and resistance. Yes. Now come to channels. So channels basically show an uptrend or a downtrend. So this way, what is this? This is an uptrend. See, this level breaches this level, the next level. Again, this level breaches this level, and again, this level breaches this level. So there is a clear uptrend. This is an uptrend. Same happens with downtrend also. So what is this? This is a downtrend. So this is what channel is. Okay. Now come to the next, which is a wedge. So wedge is basically a confusing situation, as you have, it is mentioned in your PPT also, that the prices may, it is basically a confusing market. It shows a confusing market or a sideways market. It is also called confusing market is a sideways market. What it signifies? It signifies my question is, in the sideways market or confusing market, what should be the decision of the technical analyst? The decision will be not to do nothing actually. If one has invested in it, stay invested, or if have not in, or if a particular person is not invested in it, then she should avoid. So sideways market is basically show a confusing situation. Let us show it with the help of a diagram. So basically, it shows a wedge, and it is a confusing market because from this you cannot tell that whether this is an uptrend or whether this is a downtrend. Head and shoulders, very important factor which is considered by the technical analyst, that is whether to invest in a particular company or not. So simple head and shoulders. So this is shoulders, two shoulders. This is a head, and this is a neckline. And whenever it breaches this, the decision will be to, generally the decision of the technical analysis to sell. Because there is a concept behind it, human psychology. Let us see the psychology. The prices have increased, it comes down. Bulls have regained their full strength from increasing it to this. It again goes down. Bulls have again showed their strength, but now their strength weakens. It does not breaches the previous high. It comes down, and then it breaches its previous low also. So it means the strength of the bulls are waning. The bulls are becoming weak and the bears are active now. So in such situation, the technical analyst will likely to sell. Inverted head and shoulders. Inverted head and shoulders. This is shoulders. This is head. This is the neckline. Here, what would be the decision? The decision will be to buy of the technical analyst. Why? Because here, the same psychology. Let us see the psychology, human psychology. Share is falling down, stock prices. Again, it goes up. Bulls are regaining their strength. Again, bears are active. Bears show their strength. Get it down here. Again, it goes up. Again, it comes down. But it does not come down below this level. It means now the bulls are regaining strength. It managed to prevent it from going down further from here. See, it managed to prevent it from going down from here further downwards. And it again, the bull show their full strength, and then it managed to get past here, the previous high. This is the previous high. Managed to get far from here. At this level, the technical analyst thinks that yes, now the bulls are in full swing, they are regained their strength, and it is time to buy that because there is a likely chance that the share prices will likely to increase further. Now come to the triangle or the coil formation. It is again similar to wedge, confusing situation, and it shows a sideways market. In the sideways market, the technical analyst will likely to avoid investing in a particular stock because no trend is showing, neither uptrend is showing, neither a downtrend is showing. Therefore, it is best to avoid in such a situation when the market is sideways or giving a confusing signals. I will give you this, you can correlate it with that. This is the sideways. I will give you a glimpse of the sideways market here. Here, this is a sideways market. It is showing nothing. Where it is, whether it is going up or whether it is going down. So this is basically a confusing market, this portion, a confusing market or a sideways market. Flags and peanuts, it also shows a trend, uptrend or downwards, so which we have already discussed. Any question you can may please ask on this. I will go further. Now come to another very important part, double top form. And Many of the technical analysts basically rely on this double top and this double bottom form. Double top, just give it a second. Here, see, there is the two top, one top, and this is a second top, and this is a neckline, and then it comes down. So at this portion, what will be the decision of the technical analyst? It will be to sell. Again, the basic psychology, the bulls give their strength, falls down, again shows their strength, but now it breaches their previous low. So now the technical analyst can see that yes, the bears have regained their strength and it is time to sell. So this is basically a double top formation. What is the double bottom formation? It's a double bottom. See here, there are two bottom, one, and this is the second bottom. This is the neckline. Once it reaches the neckline, the technical analyst will likely to buy. Why? Again, the basic human psychology. Here, the bulls have regained their strength because now it is from the previous high. This is the high. It is surpassed its previous high. So at this time, the technical analyst thinks that now the bears are active, regained their strength, and it's time to buy. Now gap. Gap is basically the difference between the opening and the closing prices. Wider the gap, better the indication. For example, if the particular share price have opened at 100, but it is closed at 80. wide gap, big gap, and it shows a good downtrend. At this portion, the technical analyst thinks that majority of the people are selling and it is giving a bearish signal. At this time, it is likely to sell. So, giving an example. Now, again, a stock price of a stock is say 150. It opens at 150. Okay, open at. As you know, the market opens at about 950 and it closes at 330. 9:15 opening and the closing at 330. So at opening time 9:15, the stock opens at 150 and closed at say 180. Big gap. 150 to 180. There's 30 rupees, 30 rupees gap. So at this time, it shows the word that the bulls are active, more buying is going on. It is time to purchase. So this way, the technical analysts take decision on the basis of the gap also. Wider the gap, better the you can say technical analysts are equipped to take the decision on whether to buy or sell the shares. Now, there are certain, you can say, mm, decisions are taken on the basis of data analysis. And one of the very important things in this that is moving averages, simple moving averages and the arithmetic moving averages. Both of these are followed by the technical analyst. Arithmetical moving average is followed when basically the outlook of the technical analyst is long term. And exponential moving average is followed by investors which have a generally short-term view. What is the reason? The reason is that the exponential moving average, in exponential moving average, weight is assigned to weight is assigned to more, I would say more weight. More weight is assigned to recent prices. More weight is assigned to recent prices in exponential moving average. Both these are widely followed by the technical analyst. So there is a 200-day moving average. It depends upon analyst to analyst. If analyst outlook is slightly long term, that is up to 1 year, then he will take a 200-day moving average. If his outlook is medium term for a few weeks or to a few months, 60 days moving average. If his outlook is on a daily basis or for a 1 week, then he will take a 10-day moving average. So it depends upon a particular technical analyst to another technical analyst. Exponential moving average, I have already discussed. Okay. Now, this is the evaluation of the technical analyst. As I have already discussed, crowd psychology or the herd mentality works in case of, you can say, technical analysis. Because if a particular investors have invested in the stock of a particular company, many people are likely to go ahead with the trend. If there is a stock is showing an uptrend, let us invest into the stock of that particular company without any proper knowledge. But sometimes with proper knowledge also, the technical analysts see that there is an uptrend and there is a logic behind it, and this uptrend is in similarity to whatever trend which has been observed in the past. Then they also may likely to invest in the stock of a particular company. Then technical analysis helps in directing the shift in demand rather than early. So we have seen that technical analyst, very important principle, that is the market discounts everything. It discounts the future prices also, what is likely to happen. As we have seen that one of the student is asking about the recent volatility, recent corrections in the stock market last week. The last week the stock market was falling, presently falling. What is the reason behind that? There were two, three reasons which were actually pertinent in that. We have discussed it. First is the election jitters, which we have experiencing it, and deflation in the China and the inflation in the USA. So these factors also affected the Indian market and consequently its stock prices also. Now come to evaluation of technical analyst. Argument against the technical analysis. Random walk theorist raises doubt over the usefulness because according to random walk theorists, market cannot be predicted. So technical analysts on the basis of various analysis thinks that yes, the market can be predicted up to a certain extent. But the random walk theorists say that the market cannot be predicted. And actually, many people are not now using the technical analysis on a consistent basis. The you can say the importance of the technical analysis is actually declining with the because more and more people are now using it. Now come to another very important concept of this technical analysis is efficient market hypothesis. So what this efficient market hypothesis is? Efficient market hypothesis is related to random walk theorist. According to efficient market hypothesis, the share market cannot be predicted. The stock price of a particular company cannot be predicted. Why? Because the market price reflected everything. It has reflected the past prices. It has reflected the publicly available information. It has considered the future prices also, how the market can be predicted. I will give you an example of this. Let us say a fire broke out in a particular company, in the factory of a particular company, a large company. When the news broke out, the share prices fell by 10% because of the fire broke out. Next day, another news came that because of this fire, most of the goods have been damaged. So again, the share price is down by 10%. First day, the news came that the fire broke out, then the stock prices have come down 10%. Again, next day, the news came down, the most of the goods which were in the excuse me, in the godown of the factory have come down. Again, the share prices come down by 10%. Next day, again the news come out that the company will be managed to gain most of the recover, most of the loss from the insurance company. Will be likely to company has insurance, the company will most likely to recover majority of the amount from the insurance company. So when this news broke out, the share prices again goes up by 5%. So see, the market reacts to different news in a different manner. So the followers of efficient market hypothesis says that how the market can be predicted because market reacts to different news differently. How this market can be predicted. So they gave their you can say logic on this basis. In efficient market hypothesis, there are three forms of level of efficiency: weak form of efficiency, semi-strong form of efficiency, and the strong form of efficiency. So, in a weak form of efficiency, it reflects the past prices. Semi-strong form of efficiency, it reflects the publicly available information. What is the publicly available information? The company has declared dividends. It announces that it will declare a higher dividend. So it will give a boost to the share price. Market will discount it, this information. Company has come out with a bonus shares. There is a mergers and acquisition proposition. So this is what is semi-strong form of efficiency. And strong form of efficiency, the market can say discount or reflect not only the past prices and the present prices, but also the you can say prices which are not reflected in the public domain, which is generally considered as the insider information. As you say, if we will take the example of this mergers and acquisition, for example, if any mergers and acquisition proposition is coming, so people who are in the domain of the company, for example, the company's chief financial officer, the chief operating officer, the people who are handling this mergers and acquisition, they are of this, they know this particular information that the company is coming out with a merger and acquisition, which is not in the public domain. So they will likely to take action on this basis. Whether they take action or not is a different thing, but they are most likely to take action on this particular information. So uh, they will take action on this information, and the market will reflect this information also, because if they buy a particular shares on the basis of this information or they sell the shares, the charts or the prices will reflect this information. So the you can say the followers of the efficient market hypothesis or the random walk theorists are of the view that the share prices cannot be predicted, because everything, every information, whether it is a past information, whether it is a present information, whether it is any insider information, that is taken care of by the market prices. There are certain challenges to the efficient market theory. Uh, uh, if information inadequacy, it is true that every information is reflected in the market prices. Okay, but this information is not widely, every information is not shared to the general public, even if some information hidden from the public also. Even if this information is available in the public domain, the information processing capacity of the humans is limited. You cannot process all the information, every information which is available. So it's somewhat, you can say, poses a challenge to this efficient market theory, because efficient market hypothesis assumes that every market discounts every available information and investors know this information, but that is practically, that is not actually the situation. And as we have discussed during the course of this lecture also, that the behavior of the investors are irrational sometimes. They invest in the shares of a particular company on the basis of advice of their friends, relative, or there is some tips given in the, you can say, come through the WhatsApp or through the email, or there is something written in the newspaper, or there is some information given by an expert. On this basis, they take the decision without having any knowledge on the uh, on the particular company, or you could say without any knowledge of the technical analysis. So people act irrationally. And monopolistic influences. True that market considers every information. What about the monopolistic influences or monopolistic situation wielded by the powerful investors, such as foreign institutional investors, which are actually cash cows, which are the huge cash on their disposal, and they affect the market to a large extent, because as we have seen the example of the bond yield, because of the bond yield in USA is in the higher side, or if the investor thinks that it is bond yield is likely to go up, the interest rate is likely to go up, they will the investor will likely to flee from the stock market, certain exit certain positions from the stock market, because they think that they will earn higher return in the USA or any other country. So monopolistic influences does play a big part, and this also poses a challenge to the efficient market hypothesis. So I will take certain multiple choice questions. Okay, now the first question which comes to you is, please attempt this. Dash is the theory based upon movement of two indices which reflect the aggregate impact of all kinds of information in the market. Just try to attempt this. Yes, any other answers? I have got some answers. Yes, the correct answer is the efficient market theory. Correct. And very well done, Abrakesh. The right answer you have given, the on option C. Well done. Now attempt this second multiple choice question. The price is of share in stock market can never be predicted. Second is the price trends are not the result of any underlying factors. And third is no connection can be established between two successive peaks and troughs. The above points hold true as per we have just discussed this. Please attempt this. Share prices cannot be predicted, and there is no connection between two successive peaks and highs and lows. Any answers? Yes, Prerna, correct. There is a random walk theory. The correct answer is the random walk theory. Okay. Now this third one, if the price reflects all information found in the record of past prices and volumes, it indicates dash form of market efficiency. Please attempt this. Anyone? Past prices that reflect the past prices. Yes, okay, Prerna, this weak form of efficiency and answer is A. Abrakesh, well done. The answer is weak form of efficiency, as we have discussed. Okay, now attempt this again. As per, yes, Veda, good. Weak form of efficiency, correct answer. As per Dash, no investor can outperform the market as every stock is appropriately priced as per the available information. Yes, student, as per the Dash, no investor can outperform the market as every stock is appropriately priced as per the available information. Yes, student. No investor can outperform the market. Prerna, in Dow Jones theory, we have discussed that market can be predicted. Technical analysts take decision on the basis of the primary movement, secondary movement, and the minor fluctuation. So answer in this case is the efficient market theory. Now, this is the last MCQs I will be asking to you. An investor investing money for a very short period expects, please attempt this. An investor investing money for a very short period expects return from price movement, dividend income, benefit from both price movement and dividend, or none of these. Any other attempt? Any other attempt? I think the right answer is return from price movement. As Abrakesh, we have discussed that the investor which whose emphasis on a very short term period basically wants a return from the price movement as per the technical analyst belief. So very well done, students. Thank you so much for your patient listening. Ashish sir is here, and Ashish sir, welcome.
Welcome, student. Thanks a lot. Thank you for your joining. You have made very sense interaction session very interactive. Now I request the technical to open up this Zoom link for the all students so that they can interact with us directly. Ashokji, please. Okay. Any student can ask any type of query. So after that, I will. Yes, Abrakesh, please ask your query, beta.
Good morning, sir. My question to Banerjee, sir.
Yeah.
So what is the source of all these data for technical and fundamental analysis? For suppose listed company, it may be their annual report or details on MCA sites. But how far they are reliable to make technical analysis and fundamental analysis?
Actually, go through the NSE website. Various informations are available. You can go to the website of Money Control also, where the information is also available. You can also go to this Skinner also. You can get this information from Skinner also. And here, as I have shown you, this investing.com, there is the various data regarding technical analysis is available. So there is lot of information is available here.
So how far they are authenticate?
There is authentic information is authentic. Therefore, if you want to check the authenticity of the information, you always should consult the NSE website.
Okay. One more question, sir, to you. Any reference reading for detailed study on this subject, security analysis?
I think whatever is given in the study material is
Yes, sir.
sufficient to
Can
you.
I
Yes,
supplement?
sir.
Okay, you a student, you have asked a very good question. Now, please note that here the coverage of our technical analysis in our syllabus is quite bit limited. Otherwise, technical analysis is a very huge topic. Okay, you will find n number of books there, and everyone has their own interpretation. Especially in case of a technical analysis, we cannot say there is one method is good one. Okay, like for security valuation, we have a Gordon growth model, two-stage growth model, three-stage growth model, free cash flow model. All models are there that are established there. But for technical analysis, development takes place, and every technical analysis have their own interpretation. One technical analyst may be using one approach, another may be using another approach. And in this regard, there is one disclaimer also we give. Student, please note that these classes are meant only for the academic purpose, and we never encourage a student to go
Yes,
for
sir.
investing. Encourage the students to go for speculating in the market. Once you go through the
Yes, sir.
exam, your CA exam, final examination, then you please contact us. Of course, we shall guide you on the various other sources as well.
Sir, I am asking for academic purpose only. Not
Academic
for
purpose, that is enough. For study material, in a, I think technical analysis, we have covered a very in a comprehensive manner.
Okay.
Okay. And normally, if I will refer one thing more, if you can do so. Normally, you have asked about the data about the unlisted companies as well. Now, student, in this regard, important one thing, you please refer one financial newspaper on daily basis. That is also mentioned in our study material as well somewhere. And we prefer a student should refer if one only one. We cannot say you refer three or four, but at least one as per your own choice. You can refer the financial newspaper on daily basis. So what happens? You may have a glimpse of how the market react. Now I'm just supplementing for your discussion. Recently on the 9th May, I think market have lost in a very big way. Somewhere around Nifty has around 630 points, somewhere around this. And so what all this? It was a pre-poll reaction of the market. So all this plays a role. So you will come to know how the market reacts to this all news. That will begin. And if any other question you have, Abhikesh?
No, sir. Thank you.
Okay. Okay, student. I think now I can wind up the session. Students, in this session of technical security analysis, basically there are two parts. One is fundamental analysis, another is technical analysis. In this regard, I want to add something. In this regard, I will like to add something, if Vivek sir, you permit me. See, student, whenever you see, whenever there is a one condition that market always discount everything. Okay, because see what happens. Sometime temporarily there may be some fluctuations, etc. But ultimately, becomes to fundamental analysis. For example, if you remember that in demand and supply rule, this is a demand curve, this is a supply curve. Okay, now prices are set here somewhere. Okay, now it is always said that for suppose temporarily it may be possible that the demand may be without any reason keeps on rising. Okay, but supply is limited. So ultimately, what it leads to? It leads to price increase. But within a span of some time, supply is also increased. Okay, so again, the price will come to that level again, and it was earlier. So similarly, in a fundamental analysis, of course, in technical analysis, you may find that a company may be performing very well. The results are very good. These are very good. But ultimately, that pays. It pays the fundamental and especially in the long run. So by making both analysis supplement to each other, we can carry out the security analysis in very good manner. So from our side, we are closing this session. And student, in case if you have any query, you can send us your queries on BOS mobile app, or you can contact us at this telephone number I'm sharing with you. Okay, so you can contact at this number, or you can also send the email, that is sfm final @ICAI.in. So you can send us the email as well. So with this, whatever the problem you are facing, in case you have any doubt in study material, you can contact us on the same matter. So student, with this, we come to the end of this session. And Vivek sir, we thanks a lot. We thank you for your sparing your precious time and enlightening the student on such a interesting
Sir,
topic. Thank you.
sir, one more question. Sir,
Yeah,
one
yeah.
more. Sir, today BOS site is not working because in that there is some error message shown. The same classes.
Okay. We will check. We will ask our
Yeah,
technical
just
team.
for
Okay,
your
and student, regarding assignments, and I will advise you, please go back to our recorded lecture session. There you will get the recorded assignments are there. Already assignments that are covered here, that are already in our first batch recorded lectures are there. Okay. Prerna, you are saying, sir, notes and assignments are still not available. Yes, Prerna, please have some patience. Of course, but for assignment, you can refer to the recorded lecture of the first batch. The same assignment will be there. Okay, but regarding assignment notes, we will take 1 or 2 days. We will upload the same. Okay, students. Thanks for your patience listening and making the session interactive. And please prepare yourself. We will come with in the next class. We will take up the next topic, security valuation. Okay, student. Thank you and have a nice day. Thank you.
Thank you so much. Thank you.
Session over.
Recording stopped.